What's up, everybody? We're live. Throw any questions you have for me in the chat. Market is closing in about 20 minutes. If you're joining live, we're about 20 minutes away from the market close. If you are catching up after, then you're catching up. Precious metals markets are going crazy still. That's probably going to be the big topic of discussion today, since that's kind of the biggest thing going on right now. So we'll get into that once we get a good number of people joining on here. Give everybody a little bit of time to see the notification pop up. So haven't seen you guys in a while. I took a little bit of time away from the charts, away from the computer for family time during the holidays. So backing at it, full steam ahead. And of course, over the last week, it's been one of the most crazy weeks in at least in the precious metals markets that we've had in a long time. So of course, that happens on Christmas week. All right, let's get into what's going on with precious metals. The short answer is this is my opinion, and I'm still every day with everything happening. Maybe this opinion changes. Right now, it looks like a blow off top from a short squeeze. Now, I want to preface this by saying that I'm not long term bearish on either gold or silver. I am bullish on both. I just think it's important to temper expectations, especially in the midst of giant, insane rallies. I mean, silver is up right now. Let's see, December 30th of 2024. Silver was $29 an ounce. So right now it's up 163% year over year. That is an insane move. That is not a move that happens as a result of supply and demand. That is not a result of I mean, like, overall market supply and demand dynamics. It's not because of solar panel maker inelasticity. It's not because of controls on silver exports out of China. When you see moves like this, especially what we've seen over the past couple of months, I mean, even the last 35 days, it's up 50%. That kind of a move is there's certainly some short squeeze elements. There are shorts that are getting crushed, and B, just regular, from that squeeze, you get some bubble dynamics. Now, the thing that I want people to be prepared for is like the beginning of January. So, because right now you are probably sitting on some pretty big gains on your silver positions. I know a lot of people who watch my channel, they're big precious metals investors, as I myself am, and many of you guys are also traders. And so you're looking at, you've got $10,000, $50,000, $100,000, $300,000 worth of gains unrealized on your silver positions right now. And you're thinking, okay, if I sell this right now and lock in these gains, I'm going to be paying $5,000, $20,000, $100,000 in taxes on just this sale. But if I can wait 2 more days, if I can wait till Thursday or Friday to sell this thing, then I don't have to pay taxes on that for an entire extra calendar year. So the reason why I'm warning you about that is because there's a lot of money on the line thinking the exact same thing. And so it's very possible that we do get some good selling pressure hit silver. And a lot of the shorts who are being squeezed right now are able to kind of close out and take advantage of that selling without squeezing the price higher. Couple other things. There's the margin requirements are increasing. I don't think they'll increase much more, but um, that can reduce buying pressure because you have players who are leveraged long silver, and when markets move up like this rapidly, margin requirements moving up can cause them to have to close out their long positions because they don't have enough collateral for the new margin requirements. So that's possible as well. So in short, right now, um, I have not made any changes to my long-term silver holdings, just my regular stack of silver. Um, I just within the last couple of days opened up a very small short position on silver for my trading account, just with some puts. Um, and but it's not a huge position at all. It's very, very small, low confidence trade there. Um, and I would not be surprised at all to see this blow off top continue. Like that blow off tops can 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 go up a lot more than people think they can. And typically what happens is when the reversal does start, it is just as violent in the opposite direction as it was before. And so you could see a 50% with drawdown within a matter of just a couple of weeks. Um, Assuming that's what this is. And I could be wrong about that, but that's from from the price increase over the amount of time, the supply and demand dynamics, the things that have actually changed in the markets. That's what it looks like to me. So I could be wrong about that. In terms of gold, gold is, a savings account. It preserves its purchasing power over thousands of years. And so I typically don't have a trading position open on gold. I don't have a trading position open on gold right now. I just have my long-term gold stack. I buy, I stack gold every single, probably more than once a month, couple times a month, and nothing has changed for me on that front. I'm not. I'm not. I don't currently have an active open trade on gold, long or short. Just my long term position. Um, all right. Let's see. What do you think the long term effects of AI on the market will be? Um, the long-term effects are that it will make humanity and businesses a lot more productive. We will get more for less. I have to make a video about this soon because I finally realized the other day why there's so much misunderstanding about AI. Um, you've got one group of people that thinks AI is going to be utopian, like it's going to bring in so much wealth that is broadly distributed that nobody will have to work again, and everybody will just have all their wants and needs handled for them. And then you have another group of people that thinks it is completely dystopian. It will usher in a world where you have a very small handful of people who have all of the wealth and everybody else is destitute and is basically slaves to the AI overlords. Um, Neither of these things is how reality works. AI is a tool that enhances or magnifies or amplifies human productivity, which, by the way, is just the definition of a tool. That's what technology is. And that's what it's been for the entire history of humanity. Whether you're looking at tractors and oil and steam engines and the internet and electricity and fire, even using animals for labor instead of just your own human labor. All of these things are ways that humans have found to increase our output for the same amount of input. And when we do that, we get to offload labor from ourselves that we don't want to do onto machines that do it for us. And that frees humanity up to do other work that we do want to do. Um, and that there's no difference between anything in the past and what's going on today. It makes humanity more productive. Same thing with, like, you would have thought, like, okay, when you get a computer that can do math for you, then all the people who do math for a job are replaced. It's like, no, that's not what happened. Everybody that was doing math for their job, they started using computers and became exponentially more productive. And also other people started being able to use those same tools as well. Um, the word computer used to mean a person who computes, does calculations on paper by hand. That's what a computer was. and they became the first programmers. So anyway, the long-term effect is that it makes humanity more productive. The reason why most people misunderstand this is because AI is highly deflationary in terms of the you get more for less. So it require the things that it can help people do means you can have more output for less input. That by definition is growth. That is deflation. If you can put in the same number of hours to get 100 coconuts on an island, or you can do the same number of hours to get 1,000 coconuts on an island, you're deserted on an island, you're going to choose the latter and you're going to work towards that. And that is deflationary. You get more output for less input or the same amount of input. You get more for less. The resources didn't change, your time didn't change. It was the utilization of those resources and the accumulation of capital that allowed you to do that. You took, the seeds and you planted more, whatever. You built little tools that helped you climb up the tree easier, whatever. And so all technology is deflationary. It makes the human cost of wealth go down. Today, it costs us a lot less to acquire housing, food, luxury, entertainment, transportation. It costs us less labor to get that stuff today than it did 500 years ago, 1,000 years ago, 2,000 years ago, etc. That's what deflation is. It's growth. The problem is we live in an inflationary world. And so it's hard for people to wrap their minds around deflation being a good thing because they see wages going down as a result. And it contradicts the framework that people have built of the world around them, which is that growth means number go up. That's not what real growth means. That is masked real growth because they print enough money to make sure the number still goes up in order to offset the deflation that actually happens. And that is because the government is the biggest debtor. So they need to be able to continue to borrow money that is worth more than the money that they pay back in the future. And so these two forces are coming to a head. They just are. And all throughout history, the same thing has happened over and over and over and over again. When a government gets control of the money, they flip it over to an inflationary system, and then it destroys the money, and then everything kind of flips back over to the natural course of history, which is deflation, getting more for less. And so those two systems are starting to clash because the deflationary growth, the real growth that AI is helping push the economy towards, is starting to impact the inflationary financial system that everything else is built on. Over the long term, the deflation wins. In the short term, it's pretty easy to press that button to get more money to be printed. And so anyway, that's the reason why most people are wrong about the impacts of AI on both extremes, because they're only seeing one piece of this. The reality is, over the long term, it makes humanity more productive, and it makes it cheaper in terms of human labor to acquire the wealth, the stuff that humans want and need. And in the meantime, we have probably a big inflationary fight on our hands. How do I learn macro like you? You're my favorite YouTuber when it comes to them. I mean, I would just say study. That's all I've done for years, is read books and listen to podcasts and watch YouTube videos and study from people and, pay for their, premium research services and learn from them and read books and just study. That's all it is. If you want to learn how something works, you have to learn from the people who teach how it works. And when I was a stockbroker, I learned from the people above me, around me, ahead of me, until I kind of ran to the end of that road. And then I had to start doing my own studying on the side and outside and find other resources to learn from. And eventually that's what led me to quit, because I didn't believe in what I was selling anymore, because I learned how the economy actually worked. But anyway. All right. How do you see Tesla? I am bullish on Tesla, even though it is one of the most overvalued from traditional fundamental valuation metrics. It's one of the most overvalued stocks there is, but it's the market pricing and the possibility of them becoming insanely profitable in the future based on what they're trying to build. All right. Wow, a lot of questions have come in. All right, I'm going to try and hit them all. If I accidentally miss some, I apologize. Um, Hi, Joe. Great year. Thanks for all the alerts and trades. Yeah, my pleasure. For those of you who aren't aware, that is uh, that is my business behind the YouTube channel. I have investment research services where I share with you my trades. Um, and if you're interested in that, I will be having another opening for my program in the next couple of weeks. So stay tuned. I'll start talking about it on YouTube in the next couple of weeks. Long-term bonds, 20 to 30 years, 20 to 30 year yield in 2026. Um, my anticipation is that the 20 to 30 year yield continue to go up. The yield curve will continue to um, steepen until some sort of QE or stealth QE flips in the system. So right now, the Fed is doing not QE again, which is they're buying U.S. government bonds that mature within 3 years or less. So that's the short end of the curve. So that keeps interest rates at the short end of the curve low. That's where most of the government debt is, and that's where most of it is being rolled over into. That way it keeps it fresh, and then they're ready to, once they can get long-term rates to go down. Now it's all consistently rolling over. They can roll it over into the longer term stuff once it's cheap enough. That won't happen based on free market movement. That will happen based on a combination of things like bank deregulation, to let banks just buy an unlimited number of treasuries. Um, the Fed reducing interest it pays on overnight reserve balances. Um, and probably those two together would be enough, but we'll have to see some of those big changes hit before we see the 20 and 30 year go down. And honestly, the insiders in the industry will know that's coming before the public does, and so you'll start to see the yield on those break down. In other words, the price of those go up um, before you see the confirmation of those changes happening. Who and how is the Bitcoin price being manipulated? I don't. I look at manipulation as like a last resort finger pointing type of thing. It's like these markets are pretty big, and to the extent that there is manipulation, it's like if that's true, it also depends on what you mean by manipulation, because anytime somebody buys or sells, that's going to have a force pressure on the price in that direction. Because when I buy, I am choosing to take supply off the market. Somebody's saying, "Hey, I'd like to sell here." They won't be able to sell until somebody, let's say me, comes in and says, "Okay, well, yeah, I'll meet you there and I'll buy it from you at that price." And so there's always going to be a spread between the bid and the ask. The person who wants to sell it at the lowest price available, the person who wants to buy it at the highest price available, and no transaction happens until either the buyer or the seller budges, and either the buyer comes up and meets the seller where they're at, or the seller comes down and meets the buyer where they're at. And so, um, manipulation is just like, okay, there's just like extra selling going on to keep the price low. Are there people who are using leverage in order to do extra selling, and putting themselves into a dangerous position where um, maybe they're going to have a hard time covering those shorts? Then it's like, okay, how I don't even think that should qualify as manipulation. But even if it does, um, then ultimately the price is suppressed at an artificially low price that at some point will have to be unwound. This is what I said about silver for the longest time too. It's like, okay, to the extent that it's being manipulated uh, by paper positions, eventually that has to unwind. And look at what's happening right now. Same thing about gold from like 2013 through like 2018, 2019. A lot of people were complaining about gold price suppression and manipulation. And especially in the at the end of 2019, this is when I started my YouTube channel. I was talking about that a lot back then too. It was like You want manipulation if you're a buyer because that allows you to buy more and more at an artificially low price that'll eventually have to be unwound. And they just gave you an added discount to its true value. And so with Bitcoin, there's profit taking, there's short selling, there's players who are trying to use a ton of leverage to get the price to go down to a point that'll turn other leveraged long players into forced sellers, like potentially MicroStrategy. I don't think that will work, but that looks to be the game plan right now. Try and get them to be a forced seller. We'll see. But again, to the extent that happens, if you think the asset is a good asset for the long term, then it's an opportunity to get more at cheaper than it should be. Okay. Did you not like the mustache? You had one in your last video. Yeah. So my family doesn't like the mustache. So I this summer I tried the mustache out for like a month because we were traveling in England, and I had a mishap with my shaver. I you know you, the it Even though I had the right adapter for the plug, it couldn't take it wasn't the right amount of power or whatever, and it blew my shaver up. So anyway, I had to straight shave, so I used the razor on everything but my mustache when I was there, and my family didn't like it, but I did, so I kept it for a little bit, and then I wanted to bring it back again for Christmas, and so I did that for Christmas, but again, just for them. I decided not to keep it for very long. All right, let's see. Where can we buy silver? No stocks, it seems. I mean, I'm still buying silver. Um, where are you? I mean, eh, you can buy silver right now. Just okay, I'm looking at appmex.com right now. They're still selling silver. Yeah. I I mean, I know the price is high, but if it was like not available, the price would be a lot higher. Um, we want to get into real estate as an asset class, but we are concerned about how we can make money and still not have it be time consuming management money up front. Well, number one, there's no free lunch. So there's always a cost. So the question is not how do I do something that is passive or how do I do something without a cost. The question is, um, how do I do this thing? And then is the cost worth it? Because in reality, there's nothing wrong with there's nothing wrong inherently with avoiding an asset class that you don't know or that you don't like. When I was uh when I was a broker, I worked with quite a few people who were very good at making money, um, very good at making money in specific asset classes, good investors in, real estate or private businesses or, something like that. And they felt almost like financially, I guess, not morally, like a sense of guilt. Um, that hey, for years I've known that I don't really I've been lacking in my knowledge of or my experience or my skill level at investing in stocks, and it's like, all right, from a diversification standpoint, sure, like there's a lot to be said about having a third of your assets in stocks, a third in real estate, a third in reserves, that sort of thing. But what's more risky? Um, Having a diversified portfolio where a third of your assets are in something that you don't understand at all, or having a concentrated portfolio of investments that you understand completely and that you have control over. I would argue that the first situation is more risky, even though there's the traditional de-risking through diversification. Um, and so you just like if you're good at stocks, you don't have to get into real estate. There are certainly benefits there with physical real estate, like the tax benefits. You can do a cost segregation study, bonus depreciate advanced appreciation amounts in the first year. Um, if you are a real estate professional in reality, then you can use that to offset your earned income. Um, there's the leverage benefits. I mean, you can take out a 30-year mortgage on a property. You can't take out a 30-year mortgage on a stock. There's the equity benefits where you can have somebody who pays you, like you get cash flow from the asset, but also it's building your equity for you. Um, Inflation really helps out a lot with that. So anyway, there are certainly benefits to every asset class, but there's always a cost as well, and that cost could be, you know, it's a lot of your capital up front because you have to put 20 to 30% down. You have to interview and go through 3, 4, 5, 6, 7 different property managers before you find one that that is actually working well for you. So there is always a cost. Um, but and you're not, there's no such thing as a free lunch. Like no, there's no such thing as passive income. Anything that is truly passive income is going to be equal to or less than the rate of inflation. When you put your money in a savings account, that's passive income, and it's going to be equal to or less than the rate of inflation. If you have real income beyond the rate of inflation, there's going to be some sort of cost for that, whether it's work or time or something else. Um, Would you invest in gold long term right now? Yeah, because I view gold as a savings account. And so and it's not even that I view it that way, or that I treat it that way. It's that like historically that's how it operates. So when you look at how much you can buy, like the stuff that you can buy with 1 ounce of gold today, it's roughly equal to the stuff that you could buy with 1 ounce of gold 500 years ago, 1,000 years ago, 2,000 years ago. When you look at the salaries of army captains, it's the same in gold as as a Roman centurion, 2,000 years ago. Um, so it operates very effectively as a long-term savings account, which means that in certain time periods you sell it because you're using it to buy other assets that are going to produce real growth for you. You're not going to get rich from investing in gold. It's not going to have real capital appreciation. It's going to roughly be equal to the real purchasing power changes, um, which is what you use a savings account for, or what you should be using it for anyway. It's for you to fall back on. It's your reserves. So personally, yes, if I did not have a gold allocation, I still would here. I would probably go in slowly. I probably wouldn't go all in at once. Um, because it's always possible that you're buying at the tip of the peak, um, because it is volatile. I love this channel. Thank you. Love you. All right, ITM or OTM puts. Um, I don't know if you're just referring to in general, because if you're referring to in general, Brandon, then the answer is it depends on what your goal is. If you're talking about what I said earlier, that I do have some puts on SLV right now, very small position. Those are out of the money puts. But if you're just referring to, a question in general, it depends on it depends on a lot of things. So when I'm looking at a trade, the first thing I'm what I'm doing all the time is I'm looking through the markets. I'm following investors, I'm following traders, I'm looking at what they're talking about, looking at what they're seeing. I'm looking at big movers in the markets, I'm looking at breakouts, I'm looking at charts. Like I'm constantly on the look for opportunities. And by the way, just as a side note, what you search for in life, you will find. You've all heard the phrases and the quotes that, opportunities are just problems in disguise, or problems are just opportunities in disguise. I don't know which one, but essentially, if somebody has a problem, it's like you have the ability to fix that problem. You can get paid for it. So it's like in reality, like literally, problems are opportunities. Um, But if you've ever done an exercise, like I'm sure you guys have seen some of the motivational speakers and woo-ha type of people do this exercise, but it's worth thinking about because this is really how life works. I want you guys to look around your room right now, wherever you are, whether you're in a living room or in a computer or at your office or whatever, look around you and find as many items as you can that are the color gray. Like right now, I'm going to give you 10 seconds. Look for the gray items. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All right. Now, log how many items you found that were gray. I'm assuming if you're in a cubicle right now, you're watching this on your phone, you probably found like 30 things that were gray. But how many things did you find that were red? Don't look. How many things did you find that were red? In your mind, you could probably maybe think of one thing you saw that was red. Now I want you to look around again. You have 10 seconds to find the red items. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. I bet you found a lot more red items this time when you were actually looking for red items. And that's how our brains work. It's not, obviously it's not, voodoo or magic or whatever. It's just that what you are looking for, you will find. Like literally, that's how our brains are wired. If you are looking for gray items, you will just ignore all of the things that are red because you are only looking for gray items. The reason why this is important in reality is because as you go through your life, if you feel like a victim, if you feel like the government is out to get you, if you feel like everything is a problem and not an opportunity, if you act as if and talk about life in a way where you are not in control and everybody is out to get you and you are not responsible for the situation that you are in, then you will find evidence that backs that up because your brain doesn't want to live in disjunction with what you think is true. And so if you think something is true and you tell yourself something is true, you will find evidence to back that up. That's the way the brain works. Which means if you tell yourself the opposite is true, that you are in control, that it doesn't matter what other people do, there's always opportunities for you to figure out a way to make money and create more wealth and get ahead, and that even though it might not be your fault, it is your responsibility. And you keep on telling yourself these things, guess what you're going to find? You're going to find evidence that those things are true. And so most of my day is spent looking for opportunities in the markets to make money. Because the reality is there is always an opportunity. There's always something that's going to be going up a lot, and there's always something that's going to be going down a lot. As long as humans are alive, there will be bubbles, there will be busts, there will be booms, there will be bull markets, there will be bear markets, there will be greed, there will be fear, there will be arbitrage opportunities, there will be problems that can be solved, there will be opportunities to make money. There's no such thing as missing out. And so if you go through life looking for those opportunities, guess what you're going to find? Those opportunities. And so that's what I do is I look for those opportunities in markets to make money. And so, I mean, that's the main program. That's my thing that I sell is my investment research. It's just like, hey, these are the trades that I found that I'm actually doing. Follow along with me if you'd like. My performance is pretty good. So if you'd like to see what I'm investing in, follow along with me. And part of that process is that's the first step of the process is finding those opportunities. But just because you see something that has you have a high degree of certainty that it's going to go up or down, that doesn't actually mean you can make money on it. Imagine, let's say, okay, I know for certain because I know this company and I know their management and I know what products they're coming out with and I know what they're doing. You know for certain this company is going to go up, let's say 10%. You think, okay, well, you can definitely make 10% from that. Okay, but what if it takes 8 years for that company to go up that 10%? Well, then your annual return on that is less than the rate of inflation, which means you lost money on that. So just because you know or you think you know what's going to happen doesn't even mean that that's a good opportunity for you to try and trade on or invest in. So once I've come up with a target because I've, the fundamental or the technical research that I've done on a company, and I'm like, okay, well, I think this is a really good likelihood of this company going from this price to this price. Then I will look at what is being priced in by the market over those timeframes, because a lot of times the market is already pricing in that movement. And typically, I'm trading with option strategies because of the leverage that's involved. You can you can size your positions extremely small, so you manage your risk by keeping your position sizing super small. And that way, if a trade fails, you lose a very, very, very small percentage of your portfolio. And if it does work out, then because of the leverage that's built in, you can make a significant amount of money for your overall portfolio. Kind of like a barbell strategy. So um, I will have to look and see what the pricing is on those, because if I think it's going to go up 10% in the next, let's say 2 months, it's going to go from $100 to $110. But over that time frame, let's say the call options that are $5 out of the money right now cost $5. Well, then the entire move is priced in, and even if I'm right in a perfect world, I still only break even. And so then maybe it's okay. Well, I can't. The out of the money options are too expensive. Maybe I then look at the in the money options, because sometimes, depending on the pricing, whatever, there's a lot less time value built into those, and you'd be like, okay, well, I can make 10% just buying the stock, or if I buy this in the money option, it's going to cost me half the cost of the actual price per share, but there's very little time value built in, so I could make 20% on these options instead of the 10% on the stock. And so maybe there's an opportunity that way, but maybe there's not, and so you move on to the next opportunity, because it's like, yes, I think I know what's going to happen here, but it's not a better opportunity than anything else that's in my portfolio. I'm not going to replace something in my portfolio with this, and so move on. So in the money, out of the money depends on everything that I just described. All right. Have you ever watched Max Kaiser explain the realities of Bitcoin? I don't know what you mean by the realities of Bitcoin. I have watched and listened to Max Kaiser before. Um, I'm a fan of Bitcoin. I own Bitcoin. I talk about starting off with a 5% allocation to Bitcoin, dollar cost averaging 5% of your future investments, and never selling. I think it's an asymmetric bet. I don't have any thoughts on lumber suppliers right now. Man, I'm sorry. There's so many questions here. I'm trying not to miss any. But I probably will. Can the Fed inflate forever if population shrinks and ages too? I mean, you can only inflate until people stop using the money. Then it's like, okay, then it's not doing anything. It's just printing money in a vacuum. And so as long as people continue to use the currency, they can continue to inflate, which is why it's always a balancing act between, if they do it too much, then it accelerates that timeline on when people stop using it. And if they, do it too little, then they don't get all the benefits of controlling the global reserve currency that they could. Can't print silver. I mean, you can't print physical silver. You can dig it out of the ground. You can't print physical silver, but you can print paper silver. That's what leverage is. Okay. What is the average commission or payment structure being a stockbroker? I'm not sure exactly what you're asking there, Aaron, so I'll answer it a couple of different ways. Typically, your investment advisor, financial advisor, they're going to be on a percentage of assets under management structure, and so they'll make it depends on whether you're talking about at a larger company or at a small little RIA. At a small little firm, they're going to have, they're going to be getting paid like 1% up to, maybe 2% on their book. So, of all of the assets that they have, that they're managing. They're going to be putting that money into like index funds. And so then all those index funds have their own fees that those fund managers are collecting. But your investment advisor, financial consultant, whatever they're called, will be collecting that as a fee from your account. If you're looking at like a bigger company, like a Fidelity or even a Vanguard or Schwab, or a lot of times like Edward Jones, a, a lot of larger companies, most of the time these guys are going to get paid a lot less on assets under management and a lot more on new assets in the door. So they're going to get paid a you know probably their 2% or so on assets that they bring in for the year, just a one time. And then they're going to collect a much smaller residual on the assets on their book. The reason why is because it's a lot more of the brand bringing in the money. Like, you're not going to put your assets with an advisor at Fidelity because of that advisor. Usually it's because you're going to Fidelity already and you just get assigned that advisor. And so the brand is doing a lot more of the work on bringing in the assets. I'm sorry, on keeping the assets. And so the advisor will get paid more on just like the work that they do to like do the individual sales one-on-one, to get you to consolidate everything with them instead of just having just your one account with them. And they also take over books as well, so they're going to get paid a lot less on their book value. It's not like it used to be where they're calling you up and recommending stocks and then getting paid a part of that commission. There's no commissions on trades anymore anyway. And so it's not like the Wolf of Wall Street or anything like that. That's not the way it works anymore. They're putting you in mutual funds, in ETFs, and collecting 1 to 2% of your account value as a fee from your account. I wish I had majored in finance. They said tech was an easy path towards a six-figure job. I did not major in finance. I think that is a little bit of a hindrance if you want to know how money really works. I actually went to school. I went to Bible school. My degree is in Christian ministries. I was on the path to become a pastor until I graduated with a ton of debt, started studying money to try and dig myself out of the hole that I was in, and kind of fell in love with the at first personal finance and then investing in the industry, and got a job as a broker training program, and the rest was history. I think it's a disservice for most people to, if they want to learn how money works, to get a degree in that field for the most part. And especially in finance, it's like you will know more than any financial advisor you'll talk to about the economy and about how investing works by spending 40 hours watching YouTube videos, listening to a few podcasts, and reading 10 books on the topics. You do that, I promise you call up any financial advisor, you're going to walk circles around them. So yeah, it's not the degree is not necessary. How do you view the rise of populism in the U.S. over the past decade? Everyone seems to think that more laws are the answer to our problems when the government caused it in the first place. You know that saying, the greatest trick the devil ever pulled was convincing the world he didn't exist? Well, the greatest trick the government ever pulled was convincing people that they were the solution, not the problem. And I think it's just a fundamental, the fundamental problem is the inability of people to peel back the layers. It's like, it's really easy to see a symptom, and it's really easy to try and address the symptom. It's like, I have a headache, I'm going to take some Advil. Next day I have a headache, I take some Advil. Next day I have a headache, I take some Advil or Tylenol. Next day I do that same thing, and now I'm in the ER because of liver failure because I took too many painkillers. It's really easy to try and just notice the symptom and then try and address the symptom. What's a lot harder is peeling back the layers and diagnosing the root cause and the issue. It requires a ton of critical thinking. Not only just like critical think, like what that really is. Critical thinking is it's not just thinking hard about something and being able to like people throw around the word critical thinking all the time. It's the ability to consider the opposing argument as if the opposing argument is true, solidify that opposing argument, and then still be able to figure out whether it is correct or not. And so it's like if you want to, if you're scared to read the Communist Manifesto because you think that it might convince you that communism is good and capitalism is bad, that's a sign that you need to develop a little bit of critical thinking skills. People approach politics with a religious approach, meaning this is the faith. I must believe this if I want to be good, or I must ignore my doubts about this. Otherwise, if I entertain my doubts and look into this, the other side, then I might be convinced and my whole worldview shatters. But at the end of the day, why would you want to willingly live in the shadow underneath a wool fleece because you're scared of the truth? I mean, there's nothing. Well, I shouldn't say that. The truth can be scary because it can shred down your worldview if you think the world is different than it is, and that is a terrifying thing. But it is better. And so I think the more that people are able to approach the world with the willingness to contemplate the opposite of what they think is true and try and imagine that that is true and look at the arguments for that and, you know, entertain that that could be true. The more you're able to peel those layers back and get to the root cause and find out that the government is usually that root cause. All right. Hey, man, I have 31% of my money in Bitcoin. The rest of my finances are in the S&P and NVIDIA. Well, NVIDIA, I'm assuming you meant NVDA. I also have real estate. I'm a dual citizen. Well, first of all, good job. You're ahead of many people in multiple regards there. So fantastic. Oh, you followed it up with another one. My question is, should I get more Bitcoin? Personally, I like starting off with a 5% allocation and then dollar cost averaging 5% of future investments. And if Bitcoin keeps doing what Bitcoin has always done, that will probably result in you ending up with a much higher allocation of Bitcoin than 5%. I don't like starting off with more than that because if Bitcoin doesn't do what it's always done, then you risk losing a large percent of your portfolio that could be devastating, if not impossible, to come back from in the future. A 10% loss requires an 11% gain just to get back to where you were. A 20% loss requires a 25% gain just to get back to where you were. A 50% loss requires a 100% gain just to get back to where you were. And so risk mitigation is the key always in all of life. It's about asymmetric risk. But especially in investing, because losses are exponentially more powerful than gains. And so if the only thing you ever do in investing is limit your losses and make sure that no matter what happens, you cannot have a large loss, then your profits will take care of themselves and then they'll take care of you. All you need to do, or the number one thing you need to do, is make sure that no matter what happens, you're not risking a large loss. And when you have 30% of your money in a single asset that is very volatile and has not been around for thousands of years and has the potential to like shut off, if let's say there's nuclear war and the internet goes down or something like that, or just people just don't want to use it, then I think, in my opinion, that's not treating risk appropriately. Now, it's a gamble. It could pay off for you for sure. And for many people who have, in the past, they put 100% of their net worth into Bitcoin. Obviously, it paid off. But just because the result does not dictate whether the decision was right or not. The thing that determines whether or not a decision was the correct decision is the information that you had at the time, not the information that will be available in the future. And so it's like, if I don't die in the next 10 years, then my term life insurance policy will have been a big waste. I'll have wasted, a lot of money on my term life insurance policy. But that doesn't mean that it's a bad decision because in the moment, I don't have the information that I will have in the future about whether I will actually survive or not. And so if I don't, then I will need that life insurance to replace the income for my dependents. And so the thing that makes a decision good or not, or good or bad, is the information that you had at the time, not the future result. All right, let's see. Next question. Did you skip over answering the Tesla question? I didn't see a Tesla question other than the first one where somebody said, what are your thoughts on Tesla? And I said, I'm bullish. I like it, although it is high risk. Let's see. And I do apologize for any questions that I miss. Obviously, there are a ton of these, so I can't hit them all. Is there a special way you have to request a close out of the money option that has no bid? I had a market order expire. Yes, you have to call your broker and ask for a cabinet bid. Market order is essentially, it'll get filled if there's somebody else that meets you on the other side of that trade, which would require an actual purchase. And so usually that'd be like they buy it from you for 1 cent. And so you can call your broker and say, hey, I'd like to get rid of this out of my account before the end of the year because it's, it's at 100% loss, but it doesn't expire until January or February. And I just want to take the loss on it this year. But I tried a market order and it didn't fill. And so they'll do something called a cabinet bid for you, where they just basically say a zero bid order. It goes out to market makers, and the market maker may, it's not a guarantee, but usually they'll take it from you because they can take it from you for nothing. And so then you're able to eliminate it from your account and book that loss. So you usually have to call for it, because if you place an order yourself, it's going to be for like 1 cent, and that requires a purchase from somebody else. Let's see here. Now, just so you guys know, it's kind of, I'm trying to scroll through the comments because a lot of you guys are talking to each other in the comments, which is great. I'm just trying to find all of the questions directed at me in the chat. Okay, how passive is the hedged hypergrowth portfolio blueprint? Is it suitable for somebody with a W-2? Yes, it is. It is very set and forget. It's maybe, a couple times a year rebalancing. Thoughts on TLT? Thank you for the super chat, Alex MP95. Appreciate it. My thoughts on TLT, because it's a 20-year plus treasury ETF, is that the price will continue to trend lower as yields increase until long maturity type of QE starts. And that doesn't necessarily have to come from the Fed. That will happen through things like bank deregulation. They're probably going to eliminate the supplementary leverage ratio for banks, which means banks can buy an unlimited number of US Treasuries. That will be QE through the banks. They may reduce or eliminate interest paid on reserve balances at the Fed. Although right now the Fed doesn't like that idea, but a change in leadership, they could change their tune on that, and that would force a couple $1 trillion out of out from the bank reserves, out from the Fed into treasuries. Both of these will probably, I mean, right now, banks can treat treasuries like reserves anyway, because if push comes to shove, the Fed can reopen the Bank Term Funding Program, which allows banks to sell treasuries at full price back to the Fed temporarily. And that's how they dealt with the Silicon Valley Bank blow up. So, in the case where banks load up on treasuries and then interest rates go up, and then there's a bank run, they can utilize the BTFP again. So anyway, yeah, TLT, I think continue. I'm bearish for now until a change like that happens. Then I would flip bullish, because it means there's trillions and trillions and trillions of dollars going into the long end of the curve. Okay. Cody Roundtree, thank you for the super chat. Would you bet Waller for Fed chair? I would not be surprised. You know what's funny? Yesterday, Trump said he still might try and fire Jerome Powell, which is like, at this point, I mean, he's got a couple of months left. What, like, why? Anyway, yeah. So Hassett, I think I would put at the top of my list. The people who Trump tends to put in positions of power tend to be people that consistently and continuously and without any variance, like, sing his praises and say the things he wants to hear. And Hassett is pretty good at that. So I think he's probably at the top of my list if I was going to be betting on it, which I'm not. Warsh is Kevin Warsh is also another one that I would put up there. So yeah, we'll see. All right. Like wrench help. I'm new here, but if you'd like wrench help, let me know. I don't know what wrench help means, Aaron. You could let me know. Okay. Deregulation of the banks. Okay, so this is from Virinder Singh. And I'm sorry, I'm really bad with pronouncing names. So if I butcher anybody's name, just in advance, I apologize. When Fed help regular bank holding treasuries, if banks in loss holding treasuries, Fed help cutting losses. Explain about Fed funding program to bank. Okay, so I think there's a little bit of a language barrier there, but you're basically asking about what happens if banks have losses on treasuries. So same thing that happened back in 2022. Banks buy up a bunch of treasury. Well, they bought them in 2020 and 2021 when interest rates were super low. Then the Fed ratcheted up interest rates, and so that means prices go down. That's how bonds work. The interest rates and prices are inversely correlated. And so when the Fed increases rates, that means the price of those bonds that all the banks bought went down. So they're sitting on a bunch of unrealized losses. Well, if somebody then, or all the depositors at that bank, if they start to request withdrawals, banks don't keep all the deposits on hand. So they have to sell everything that they own in order to supply the depositors with the money they're requesting to withdraw. Well, if everything that they own is currently at a loss, they could sell everything and they still wouldn't have enough to meet all the withdrawals. And when banks get into those situations, it causes bank runs because everybody's like, well, if I'm not first out, then I don't get my money. And so that's exactly what happened to Silicon Valley Bank. So what the Fed did was say, okay, if you're a bank and you have treasuries that are at a loss, you can sell them to us instead of selling them on the open market for a loss. You can sell them to us, and we'll pay full price for them. Um, and you just have to promise to buy them back from us within a year. And what that basically did was it stopped the bank runs from happening, because it means that, okay, well, now I know the bank can give me my money, so I don't have to take my money. Um, and so if banks are allowed to buy an unlimited number of US treasuries, then that kind of thing has to be implicit in the background. Otherwise, banks will not buy an unlimited number of treasuries because they still have to worry about losses on those. Z Stabs, is copper undervalued? I am long copper miners right now. I like copper right here. There are a lot of commodities that I like right here, but copper is definitely one of them. Um, Aaron, wrenchability is referring to limited moderator ability. They were spamming earlier. Not a fan of banning people, but stopping spam. Yes, I'll probably need to do that at some point. Right now, there's usually about anywhere between 200 to 400 people on these lives at any given time. And so I've been able to kind of stay on top of that myself. But today I went on a couple long rants before getting to the bottom of the chat. And so I missed all those spamming, those little spam attacks there. Um, so at some point I will definitely need to add some of you guys as moderators to prevent that kind of stuff from happening. Um, all right, let's see. Um, all right, from Jonesy 920X, since I can only buy gold in my 401k before I retire, about 3 years, what do you think about OUNZ, where I can redeem for actual gold for a fee? Uh, the only situation in which that actually matters is probably one where it won't matter anyway. Like if you have to go through an ETF to request physical delivery because the world has gotten so bad that you need to use physical gold for purchases, then like how are you going to do that anyway? Like if the financial system has collapsed to the point where like you actually need physical gold to like buy stuff, how what electronic records are you going to go? Who are you going to contact? Where are you going to go for that redemption? Um, so I think it's probably not. I mean, what's the expense ratio on OUNZ? Expense ratio OUNZ. 0.25% versus GLD 0.4%. So it is cheaper. So for that reason, I would prefer OUNZ over GLD. What about PHYS? 0.4%, 0.39%. Yeah, so for that reason, I would like it, but not for the reason of being able to request physical delivery. Um, Now I think there's value in having physical gold, but if you're doing it in a way where it might be difficult or impossible to get it when you actually need it, then how much value is that actually providing you? Um, but I like the expense ratio. It's cheaper than GLD. So as long as the bid ask spread is good enough and you're, let's see, OUNZ. Yeah, it's yeah. Yeah, I wouldn't see any problem with that over GLD. All right. Thank you for the super chat, Brando. Appreciate it. Thoughts on Monero XMR? That's the privacy one, right? Monero XMR. Is that the privacy one? Yeah, private, untraceable. Look, my view has not changed that I like Bitcoin and I don't like any other cryptocurrency. Um, it's possible that changes in the future with things like, because there's always a trade-off, right? And so to go with things that are truly anonymous rather than like Bitcoin is pseudonymous, there is a trade-off, and it might be that in the future that trade-off becomes worth it. Um, but at this point, I have not seen a really strong case that those trade-offs are worth it. Simply because money tends to be a winner take all game, and you get layers built on top of the base money that serve the different functions rather than different forms of money serving those different functions. So like the dollar is a layered money system where you have Fed wires at the very bottom. It's like nobody settles on chain except for like when you send a wire for a down payment on a property or like banks transfer money to each other. It's like that's like the base layer. And then you have other layers built on top of that, like ACH bank transfer, and you've got, credit cards, you got checks, and you've got Cash App, and you've got Apple Pay. You've got layers that are built on top of that for very specific purposes to solve those specific needs. But at the end of the day, it's layers on layers with that, the dollar as the bottom layer, the very inefficient, bottom layer. Um, so I don't see a reason to expect that if Bitcoin becomes money, that it would be any different. All right. From unknown YTX, what do you think of the circular money scheme going on between NVIDIA, OpenAI, Oracle? Seems like they're cooking their books. It's not fraudulent what's going on. There's nothing inherently fraudulent about like circular financing. Because at the end of the day, like, well, this is one thing. This is not the main thing, but this is one thing. It's like they're not doing this in a vacuum. Like this is like publicly available data and information about the investments that are being made and the money or the payments that are being sent back and forth between these companies in terms of credits for usage and things like that. And so it's like there's a good amount of these companies that are still institutionally owned, with all of that data being it's pretty transparent. Um, Now I know that there have been like frauds and stuff in the past that like large institutions have been involved in and invested in. Um, but a lot of times those are like it's hidden. It's like cooking the books in terms of like we're hiding the information. Like we're not making it publicly available what we're doing here. We're doing it behind the scenes, and then we're publishing false or fabricated numbers. Um, so I don't that in and of itself is not a reason for me to be bearish on those companies. Um, Also because at big scale, large scale, investments and contracts like that, this is a way to kind of keep that flywheel going to try and get the flywheel started, I should say. If in the future it does not result in any, meaningful future profits and cash flows from outside, then it does collapse. It does fail. But at the beginning, you have to get that flywheel started when you're doing something that has never been done before. Um, and so it is a little bit of a gamble, a little bit of a bet on the future, and it seems likely enough that it could pay off. but I don't think it's by itself inherently fraudulent. All right, from Karan Patel, with the largest tax refund coming in early 2026, is that bullish for markets as most of that money flows into investments? Well, not, I mean, hmm, most of those tax refunds, that's a lot of that is it goes towards consumption, not investment at first. So, like when the average individual gets a larger tax refund than they expect, they'll use it to like, have a bigger down payment on a car, or they'll go, they'll book a trip, or they'll buy that computer or upgrade their iPhone, or they're gonna it's going to be most of the time that's going to be used for consumption. Now ultimately then that does, trickle up into that's business income. And so that, trickles up into investors' hands. So I mean, I think that ultimately that is somewhat of a bullish pressure on markets. But I think initially it's possible that, at least temporarily spikes inflation. Okay, let's see. Some of you joined after the beginning here, so I'll mention precious metals again, but I went more into detail on it at the beginning, so you can watch the replay. Basically, what's happening with like especially silver right now looks to me like a blow off top. Long term, I'm still bullish on gold and silver and other metals and commodities for sure. But short term, it looks like the blow off top from like a short squeeze. You don't get these kind of price movements from just like demand inelasticity. It just doesn't happen. Movements like this happen when there's a high degree of speculation and shorts get crushed, and then the price explodes when all those shorts get crushed out. And then, the speculation rushes in, and then the price collapses back down again, especially once margin rates increase and all the levered longs have to close out. We also are at the end of the year here. People are protecting their gains. I would not be surprised at all if the end of this week, beginning of next week, we kind of see an end to this spike. But I have a very, very, very small put position on silver right now, so it's not a high conviction opinion of mine, and I'm not touching my long term stack of silver. Again, long term I'm bullish, but short term it looks pretty overblown to me. Uh, Not all nighter hider, not to brag, but my blue wrench count is in the double digits, and it's a full time job just moderating the Uneducated Economist channel. Well, I am new to live streaming, guys. So if there's stuff like that is clear that I don't know what I'm doing, like moderating the chat, then keep on letting me know, and we'll get this thing up to normal live streaming standards. Um, all right. Are there any upcoming IPOs you're interested in? No. I generally don't touch IPOs because IPOs, number one, are exits for early investors. So most of the time you see what happens at an IPO is the price spikes from retail hype rushing in, and then for about a year, the price just slowly collapses, as all of the early investors, their lockup periods end, all the IPOs, like everybody, unloads on unloads on retail, and then you get to a point where it kind of bottoms out and it's a little bit oversold or at least more fairly valued, and all the selling that was going to happen from all the early stage money, all the selling has happened, and then it can start to you start to see it grow again from there. Sometimes the opposite happens where it's like an IPO gets, it happens at too low of a price, and retail gets to take advantage of that. But Wall Street typically knows how to price it to get retail to jump in, at a price that early insiders can start to unload, um, and And so that I tend to not touch IPOs until at least, 6 months to a year goes by, and then I'll start looking at them. Scroll up and answer my question about selling physical silver, please. I'm sorry, there's too many chats and comments for me to be able to go through and find specific comments about something. So, if you tag me in your comment or your question, I have a much higher likelihood of being able to see it. All right, Deep Fried Fork. Who else in the space are you following, watching, and how are you getting closest real time information on markets? I mean, this is all I do. Some of the I mean, some of the names that come to mind of just like good people to learn from are people like, you know, Ray Dalio and Lynn Alden and Safety Moose and even Peter Schiff and um, Joseph Wang, the Fed guy. And I mean, there's so many. Those are just, names that are popping into my head at the, good people to learn from. But I mean, it's just a time thing. And so that's part of what I view my role as is curating and filtering out signal from noise. Because there's lots of stuff that happens on a day-to-day basis. And so I view part of my role as finding things that are most important to let you guys know about. From 1717 Beaker, hey Joe, I joined your resource breakout group and have now completed your options mastery and technical analysis training. Thank you so much for your valuable input and training. It has really helped me. Well, thank you for the public comment and review feedback there. I do appreciate it. And I'm very glad that it's been helpful for you. Let's see. My precious metal holdings have reached 11% of my portfolio. Of that, 11%, about 80% is physical, 13% is GLDM. When I rebalance my portfolio, do I sell some or hold forever? It depends on the size of your portfolio. Like if your net worth is 10 million, yeah, you're going to have to sell in order to rebalance. If your net worth is 10,000, then just rebalance with your new contributions. Because until you're high net worth individual, you should be investing as much of your earned income as you can. And so if you're investing $500 a month, $1,000 a month, $5,000 a month, depending on what your income is, early on in your investing career, that is going to make a big impact on your overall allocations. And so maybe you have to start off with just one asset and then you build that up. And for the beginning, it's 100% of your portfolio, but it's like, who cares? You're 22 and you're investing $25 a month. It's like, if it goes to zero, it's like, it's not going to really do anything. So you build up one asset at a time. And then once that's, you got a significant stack there, you move on to the next asset and build that up until you have a decently diversified portfolio. And if one of those pops off, it's fine to just leave it as long as it's not overvalued and you haven't hit your profit target or whatever it is. And it's not, in a bubble or whatever. It's just like, hey, that one's done very well. Instead of selling and triggering tax consequences, assuming this is outside of an IRA or a 401k, then you just put all of your new investment money into a different asset class. And so if gold is doing well right now and you're like, well, yeah, but we have printing on the way. I don't want to necessarily sell that and then have taxable, capital gains taxes on that I owe. Then just, stop buying more right now and just funnel all of your new investing money into, stocks or real estate or whatever else, the other asset classes that are underweighted in your portfolio. So especially in the first quarter of your investing career, you can rebalance over the course of a year simply by changing your allocation of your new investments rather than selling your old ones. Okay, guys. I'm going to answer one more question here, and then we will end the stream and move on. We'll come back tomorrow. And for anybody who's here right now, I did talk about silver and gold at the beginning. So when I end this, you can go back and watch the beginning of it. Okay, let's see. Last question here. Okay. What cash position size makes most sense to have for an optimal BTFD strategy? Paying in from a paycheck doesn't give you much to invest the dip. BTFD meaning buy the effing dip. Personally, so here's the portfolio allocation that is just my standard general go-to that you can tweak from there, but my general standard portfolio is 30% reserves, 30% stocks, 30% real estate, and then 10% for speculation and hedging. The speculation and hedging, that done right, will give you some cash to invest on a dip, because when things are extremely stretched, when things are overvalued, when things are overbought, strategically buying some out of the money puts, those can print for you in a fast sell off. That gives you cash to be able to buy the dip. So that's number one. Number two, of the reserves, I talked about 30% in reserves. All of that could be used, if you wanted to buy the dip, or a lot of it. In my reserves portion, that 30%, we've got 20% gold, 5% Bitcoin, 5% cash and cash equivalents. So the first place that I would tap would be the cash and cash equivalents. By cash equivalents, I mean T-bills, money market funds, high yield savings, that kind of thing. And the only reason you'd go beyond just a traditional, just like, bank account or cash allocation is just because of the insurance. Like, if you got more than $250,000 and you want to spread it out. And so that'd be the first place, would be the, that you would draw from. But if the dip is big enough and you want to do more than that, that's what the 20% in gold is for. I mean, that's what real reserves are. That's your savings account. And so like the recent historical norm of the 60-40 portfolio, 60% stock, 40% bonds. The reason why they recommend that is so that if stocks take a dump and money runs into bonds, you sell off your bonds, which are the reserves portion of your portfolio, to buy more stocks on the dip. And so by maintaining that balance, then you're able to, relative to each other, buy low and sell high. And you can still do that by using gold as the reserves part of your portfolio. If stocks fall relative to gold, then you can rebalance by shifting some of that from gold into stocks, and then vice versa. When stocks do really well compared to gold, shift some of that back into reserves. And it's a relative game. So it's not necessarily that stocks are going down. It's just that gold is outperforming stocks. So they could both be going up, just gold is going up more. They could both be going down, just gold is going down more, depending on which way you're rebalancing. And so having different asset classes allows you to buy the dip relative to each other when the performance is different. So, all right, guys, lots of great questions today. Again, I apologize for not being able to get to them all. There's just too many. Also, there's a lot of other conversations that happen, and so I tend to miss a lot of the questions, especially if I'm not tagged on it. Then it might be hard for me to see. So really appreciate all the questions, though, and we'll try and do these more and more going into 2026, because it seems like you guys like it when I do it. So I'll continue to do it. All right. See you next time.